Hedging is essentially a risk management strategy used by traders and investors to protect existing positions from adverse price movements. Think of it as taking out an insurance policy on your trades. If you are long on a particular asset, a hedge can help offset potential losses if the market moves against you. The core idea is to open a position that will gain value if your primary position loses value. The classic example given involves currency pairs. If you are long the euro to US dollar, meaning you expect the euro to strengthen against the US dollar, you are exposed to euro weakness. To hedge this, you might short the euro to Swiss franc pair. Here's the logic: if the euro weakens broadly, both the euro to US dollar and euro to Swiss franc pairs are likely to fall. While your long position suffers a loss, your short position on euro to Swiss franc would generate a profit, partially offsetting the loss. This type of hedge works because of a common currency component. Both trades involve the euro, so they are correlated. If the euro declines in value, it affects both pairs simultaneously. This is not a perfect hedge, as the movements of the dollar and the Swiss franc against the euro are not identical, but it does create a powerful safety net that reduces overall portfolio volatility. Hedging is not about making money from the hedge itself. Its primary purpose is to reduce risk and preserve capital. The profit from the hedge should ideally offset the loss from the original position, resulting in a smaller net loss than you would have incurred otherwise. In some cases, a perfectly executed hedge can lock in profits or limit a loss to a predetermined amount. There are many other hedging techniques beyond currency pairs. An equity investor holding a large portfolio of stocks might buy put options on a market index to protect against a broad market crash. A commodities producer, like a farmer, might sell futures contracts to lock in a price for their harvest, hedging against the risk of falling prices. The key to successful hedging is understanding the correlation between the asset you own and the asset you use for the hedge. A strong positive correlation means they tend to move in the same direction, making the hedge effective. Using assets with a weak or negative correlation could actually increase risk instead of reducing it. It is also important to consider the cost of hedging. Hedges are not free. There are transaction costs, bid-ask spreads, and potential margins required to maintain the hedge. Sometimes, the cost of the hedge can eat into your profits, or the hedge itself can expire worthless if the feared price movement does not occur, resulting in a net loss from the hedge. Ultimately, hedging is a tool for disciplined risk management. It allows traders to participate in markets with more confidence, knowing that their downside is partially protected. It transforms a speculative position into a more controlled one. For anyone looking to scale their trading size or hold positions for longer periods, understanding and implementing basic hedging strategies is a crucial step towards long-term survival in the markets.